Good morning, everybody. It's Wall Street Beats. I'm David Maris. We have Ben Brey, Charlie Peabody, Kevin Baker, and we're going to talk to you about stocks and what we're doing and getting ready for Thanksgiving. Everything's good right now. So I'm going to start because since I'm moderating, why not? And talk to you about what's going on with some news in healthcare. So in healthcare, the administration is proposing that they cover GLP-1s or obesity drugs for Medicare and Medicaid. Obviously, very suspect political timing for this. As an administration's leaving, generally it's not great form to start putting on $35-50 billion worth of future spending that the extra or even entitlements that the next administration has to figure out some way to pay for. Now, from a public health standpoint, completely legitimate, right? We all know that losing weight on these GLP-1s has already shown to be beneficial for stroke, cancer, Alzheimer's, cardiovascular events. There's just a whole list of things that it's probably really good for. So I'm not trying to dissuade the idea of losing weight, and so what you saw was Lilly had pre-market was up a lot. Nova was up a little bit less, which is weird because they both benefit. And Lilly has a much higher multiple, so you would think that Novo actually would be up more. And Viking was surprisingly up too. And there's some other news that's out as well, which is that Amgen's GLP-1 data or obesity drug data was disappointing. Now, it works. People still lost 20% over the course of a year, so it works. It just is hard to supplant two entrenched first movers with data that's a little bit not as good as the others. So you're coming in as a follower with a not as good product. What are you going to do? You're going to have to fight price. Now, that's the part that I don't understand why Viking would be up. I get the idea that, okay, the Medicare and Medicaid coverage expands the total addressable market, but what do you really have here? You have Amgen's product that's disappointing, and you have Viking now going to have to come in with, if Medicare and Medicaid do end up reimbursing for GLP-1s, a whole user base that's going to be able to start much sooner than would have otherwise, because it would have been a slow uptake with no payment, with no reimbursement. Now you're going to get a much bigger uptake. The fact that Lilly's not up, I would have said, without knowing anything, if you said, this is the news, what will Lilly be up? What would Novo be up? I'd be like, about 10%. This is a big change. It probably was inevitable anyway, but it only being up 4 or 5% tells me that people are still selling Lilly on news. It's had a long drip down. I've been short Lilly and Novo quietly, very small, just because I thought they were overvalued. They're fantastic companies, and these drugs do work. I don't think this is a mirage or some sort of, but it just got ahead of itself. I said that I'd buy it below 700. It closed pretty close near there, and I was going to cover, but this news is good. The fact that it's fading or not up 10% tells me just to keep an eye on this, that there doesn't seem to be a lot of follow through. I'll ask Kevin afterwards. Actually, I'll ask him now. What do you see on Lilly and Novo on this? Am I right for staying a little bit short, or should I just move out of the way? I've already made 20%, so I'm okay with leaving too.
And this was part of my prepared remarks. This to me is an archetypical short. It closes below the 200-day moving average on big volume. The 200-day here is really close to rolling over. It has not yet. The 50-day, this red line that you see up here, is threatening to come through right here. And this is my biggest tell. The volume is picking up on the down days, and it's anemic on the up days, even including today. So I think anytime you get around this 800, 840 level, I think you can short it with virtual impunity. And I don't say that lightly, but this is about as classic as they get. And your 700 number has been respected. If it breaks below that, then you go into 625 pretty fast, in my opinion.
All right. So that's the news on the GLP-1s. We did have this last week, this giant reversal in the biotech index and also in healthcare in general, because what was seen originally as RFK, oh my gosh, Dr. Oz, what are we talking about? Who's next, Dr. Doolittle, and then you get the FDA head announcement or proposed head, and industry really likes this person, and he's had a lot of positive things to say about telemedicine and how it democratizes healthcare. We had HIMSS jump on that news. I'm still long there, even though $30 is my price target. I'll probably take off a good piece of that in the next day or two, just to keep with the discipline. As Kevin always says, just play with the profits. I like that strategy, but I also think that they'll earn $1 of earnings without any GLP-1s, and so I'll pay 30 times that. Everything other than that is more speculation. Let me see, anything else in healthcare? I think that's it for now. What do you see on HIMSS and HERS, Kevin?
You and I talked about this in Stock Kings for subscribers, our behind the scenes look, where you see where the sausage is made, which I recommend people sign up for. We talked about this 3044 level. We closed above that. That's very bullish. You have the 99 relative strength. That's as good as it gets. The reason I bring up 3044 is everybody is making money here. Everybody has a profit unless you're short. And so I think you've got 90% of the float out there short. And if you get any continued good news at HIMSS, I think they get squeezed. Little surprise there's not more follow through today, but it was up, 14, 15, I don't know, 18% yesterday. I forget the number. But I let my winners run. I'm with you. You make double your money in less than a year. You take the half off the table and then play with the profit. And again, I told you, I think another $10 to 40 is reasonable.
All right. Well, perfect. So why don't we go to you? I know, we had also talked last night about maybe talking about Teva a bit. And here's one that, you know what, I was all happy to pitch it on Wall Street Beats a few months ago or early in the year, and it did really well during the year. I came back on kind of half victory lapped it, like, I still own it and it's still going great. The last month has really just been a steady drip down. I worry that I'm on the wrong side of this trade. I think the quarter was great. I think that they're still under 10 times earnings, which is my target. What do you see on a chart basis, or did you work on that one? I don't know if we actually talked about that one last night.
No, and anytime you folks, you fundamental experts, bring something up, I put it into my system and I watch it every single day. So I have your back in that regard. In this case, it's holding the 200-day, but boy, I don't like this volume expanding on the down days, especially on earnings. Something there they didn't like, and so you got to wait 90 days to have some good fundamental news to drive the stock up. I don't know what that catalyst is. Maybe you do. If I'm going through, like I go through every ETF that's out there, I'm not going to be stopping on this chart. This is not a pattern that gets me juiced up. So the relative strength line hitting new lows is not good as well. Don't let the HIMSS profits go away with Teva losses. If it closes below the 200-day, I'd sell a third.
Yeah. So what price is that?
That's 16 or so.
All right. Yeah, Ben and I talked earlier today that it just feels or looks like that somebody's getting out of it and it's a steady drip lower. And that's what a lot of institutions do, is that they just put in, hey, I want to be 15% of the volume, get me out. So you see this it feels that way. But fundamentally, I think it's super cheap. Let's turn it over to you, Kevin, with whatever else you have. I know you were working on a couple different ideas. What do you have for us today?
Yeah, give me a minute because I want to get my charts going here. Give me a second, please.
No. I don't know if we can. The market waits for no one, Kevin.
No, but
I think Gordon Gekko said that.
My Charlie Peabody Luddite tendencies are taking over here, which I confess to.
I will tell you that I said that money never sleeps, and Gordon Gekko said that. I want everyone to know that movie was a cautionary tale. Like, a lot of people in our business are like, oh, what's your favorite movie? Oh, Wall Street, it was great. Or The Wolf of Wall Street, that's crazy. That's not crazy. That's horrific. That's stuff that should be, taught as it's like the same people who say The Great Gatsby, oh, what a great book. I want to live during those times. It's like, what was a criticism? It really wasn't. But okay, now we've lost Kevin completely. So
he's gone. He's gone.
Why don't we
talk
go to
about literature? That's what happens. Some people just can't take it. Too much heat in the kitchen. While we wait for Kevin to come back in, Charlie, what do you have for us?
We got the new home sales data at 10 o'clock this morning, and it was actually very disappointing. It came in at 610,000 new homes sold for the month of October, so the first month of the fourth quarter. And that's down 17% from September and down 9% year over year. So very disappointing. And that's on the heels of existing home sales, which were reported last week, that were also depressed under 4 million units. So the housing market is not showing any kind of recovery as far as I can tell. The other thing about the new home sales data is that there were about 481,000 new homes still available on the market. That's about 9.5 months supply. So it's a significant overhang of existing inventory. And I think, as Ben posted a week or so ago on the site, if you look at starts versus completions of new homes, it's the widest spread in quite a while. So in other words, they're not starting new homes relative to the completions. And as starts are your future revenues. So if your starts are way down, your future revenues are going to be way down. So I think these home builders are in trouble, and the need to add incentives to push product across the table is going to just grow from here, which means gross margins remain under pressure. And that's been my theme, is that things that need to be financed are going to disappoint. And that's because of an affordability problem. Now, what I'm trying to weigh here short term is I do believe we're going to get some kind of rally in the 10-year back towards 4%. And will that rally on a short-term basis continue to put a bid into these home builders? And it could, in the anticipation that if we get lower rates, then the need for incentives will lessen. But by and large, I would say the actual sales data is very disappointing.
So when you're looking at the home builders to short, which ones are your focus?
I've been using D.H. Horton as my number one and Lennar as my number two. It'll be interesting to see what happens with someone like Lennar, for example, because yesterday it poked above its 50-day moving average, which got people excited. And that was part of the best in trade. The best in trade is that rates will come lower, and that will help the home builders. But it may be a prairie dog where it pokes up and then just falls right back down on today's data. That's what I want to watch, is to see how these things trade over the next 3 days. Maybe this week is not the best week because it's a holiday week. But yeah, those two, they have large expense structures that need to be fed. And so they've got to push product across the table to cover their expense structure. And that means they're going to have to continue to add incentives, in my mind, which means gross margins come under pressure, further pressure.
And does that same pattern fit for Toll Brothers, which is near a 50-week high, or for a Pulte? Or are they all in the same boat, or are some of them very different?
They are all in the same boat as far as I'm concerned. Now, there are two ETFs out there, XHB, which is more home builders, and then the ITB, which include a lot of construction type names. And I'd be curious what Kevin thinks about those two ETFs technically, to see if they are trading the same.
Yeah, Kevin, can you do that on the fly, the XHB and ITB? If not, I can always do it tomorrow.
Yeah, and Charlie said these look very similar. D.R. Horton, Lennar. It's a little bit encouraging that you have this up volume here, and this is staying above the 200-day moving average. I get more excited when the 200-day gets violated. That hasn't happened here yet, but I'm with him. I think D.R. Horton is the weakest of them. And the same thing with ITB. It's above the 200-day moving average. The jury's out, and I would lean to the bullish side, but I'm not wild about this chart at all. If it takes out the 200-day, then I get more interested.
All right. Charlie, anything else before we move to Kevin's somewhat delayed but very anticipated comments?
Yeah, I just want to mention there's a rotation, no doubt. There's a rotation from growth to value, and bank stocks have been big beneficiaries of this rotation. They're up dramatically since the election. And the one name that I've been using consistently all year long, start buying it in the 50s, is Citigroup. And I just want to reiterate the fundamental story. This is an underperforming company that's maybe earning a 7% ROTCE. And I think it can get back to an 11, 12% ROTCE in 2026. There are four businesses that I think are going to show growth. One is the capital markets, which will be a beneficiary of the robustness we're seeing today, particularly in M&A and IPOs. The second is credit cards, which if we do have a soft landing, there's tremendous earnings leverage in their card business from lower provisions. The third is their what we call TT&S, their Treasury and Trade Solutions, which is benefiting from pickup in economic activity. And then finally, wealth management, which is a depressed business that they brought in this guy, Andy Sieg, who created the Merrill Lynch bullish retail space. And he's going to turn around wealth management. So I think these businesses can improve. And as they do, I think you're going to see earnings accelerate into 25 and 26. On top of that, Citi has the highest payout ratio of any of the big banks. They've got a 3+% dividend yield. And probably, given the rollback of the Basel III capital requirements, they're going to buy back as much as 5% of their stock over the next year or two in each year. 5% of their stock in each year. So I like the huge buyback when this thing is trading at a huge discount to book. Tangible book right now is about $90, and the stock is trading around 70. I think.
So what would you say to somebody? What would you say to somebody who says, "Listen, Warren Buffett's selling banks. I don't want to be anywhere in banks."
But he owns Citigroup, and he owns a very small piece of Citigroup, and he has not sold that. Yeah. I think he will be adding to Citigroup as we go on here. And he's met several times with Jane Fraser, the CEO. So I think he's going to be a supporter of Jane Fraser. And he's come out and made very positive statements about her as the new leader of this franchise. So I think Citigroup is getting the Warren Buffett endorsement, quite honestly.
Okay, so this line that I've drawn here, if we can pull that up, that goes back to the post-Great Financial Crisis high, 84.79. Yes, I'm picking this, but that's the number, which dovetails with the book value number, which obviously I hope is going to grow over time. But if I had a buck for every time I heard Citigroup trades below book value, I wouldn't be here right now. It is unbelievable, but it's just funny that there's book value at 84.79 in the technical level as well.
Yeah. Listen, this is a franchise that's had four management teams that have disappointed consistently for the last 2 decades. And I have not been a supporter of Citigroup in the past. I've been doing this for almost 40 years. And this is the first time that I've been on board with a Citigroup recommendation. So I think there's something different developing here, put it that way.
It's been a tough 2 decades for those boys.
Oh, it's been a horrible 2 decades. But I think this can be in 26 once they finish the IPO of Banamex in Mexico. And that has some issues to get done. But I think it can be a $100 stock.
All right. So there we are. Citigroup. All right. Kevin, we skipped over you before because of technical issues. What do you have for us?
I said I have. And just to show you how far and wide we go here at Wall Street Beats, I don't talk about this until I get on these shows with Wall Street Beats. This is a new buy. This is Franklin FTSE Canada ETF. And I have never owned anything in Canada ever, but I do now. Charlie, the Royal Bank of Canada, RBC, RY is the symbol, is the number 1 name. Shopify is number 2. Toronto Dominion, Enbridge, and Brookfield are 3, 4, and 5. And sorry, I'll share it. I thought
we need to see it. We see Charlie up close and personal. We need to see your chart.
He's better looking than my chart, but so be it. Bought it right here.
Your chart's not so great.
The number 6 name is CNQ, Canadian Natural Resources, which Bob Morris has been all over. So basically, some good things are going on with oil and gas, and that's what you have in this ETF. Now, to be fair, I try to own the 10 best ETFs out of the 4,200 that I look for every single month. This is probably 9 or 10, but who knows? If energy ever gets a bid, this might be a different story entirely, and that's what I own here. And I don't know what I know about Canadian banks that you could fill a thimble with. But right now, I'm long FLCA, Franklin FTSE Canada ETF, and wish me luck.
Just one quick thing on that. When I look at that upper line, that top chart, the top line, it seems like it's bumping up against that. Doesn't that tell you, okay, maybe we're going to get a better chance to buy it lower? Is that a resistance? Is that a place of resistance?
No, because the resistance is, there is no resistance. That's part of my tiebreaker. You see this?
Yeah.
Everybody's making money, everybody's happy, everybody's in the pool. And the fact that the volume picks up, with frankly Toronto Dominion acting lousily, the volume is picked up here and here. This is clearly under accumulation. That's a breakout. Yeah, picking nits, I want that relative strength line to hit new highs, but isn't perfect. That's why it's my number 9 or 10 name versus Grayscale Bitcoin Trust up 150%. But we'll see what can happen here.
Okay, perfect. Appreciate it. Now going to Ben. Ben, I think you have a stock. You're going to share your screen. I think you have a stock where the main proponent is, hey, listen, or the main idea is, listen, give me and I'll buy stuff for you. And that doesn't like proposition.
Yeah, yeah. I tried to share my screen. Can you guys see it?
No.
Oh, there we go. All right. So if you see, this is MicroStrategy, Michael Saylor's Bitcoin ETF for bondholders, if you will. The beauty of what this guy did is pretty genius. He was like, hey, bondholders, institutional bondholders have no access to Bitcoin. So he found a way for bond portfolio managers to own Bitcoin via convertibles. And so he's the sole provider of Bitcoin exposure to bond managers. And he's done quite well. Now he has a $100 billion market cap company that, David, I think it's $72 million of EBITDA. So what is that? That's 1,400 times EBITDA, I believe. Yeah, 1,461 times EBITDA. Is that a little bit of a high multiple? Charlie, have you ever trafficked in a 1,400 multiple on a stock before?
No, I'm in the lower. I'm in the 4 and 6 multiple stocks.
All right, so let's look at this thing. All right, so what I did here is that because he did a filing yesterday that updated his positioning. So you gotta, when you cap adjust this thing, I converted all the converts to shares that are in the money. You can see right here, all of them are deep in the money except for the $3 billion he just did. And to go back to the cap table. So then you have 259 million shares. That adds the RSUs and the options. Okay, and his cost basis is now 22 billion roughly of Bitcoin. If I give him a 20% tax treatment, he's got a $2.8 trillion tax liability. The break-even price is $276,000. Okay, Bitcoin's at $93,000, and so then I'll give him generously give him 15 times EBITDA. So that gives you $1 billion, which is where it used to trade before he got in the Bitcoin buying business back in the summer of 2020. So he's at 100 times since the summer of 2020, buying Bitcoin for you, as David said. So you're at a 3.3 time price to NAV, price to book, if you will. Charlie, you're a bank analyst. What do you think about a 3.3 times price to book ratio?
It's not something we see very often in banks, but that is the bull case that we are about to see that in banks in the next 5 years. I'm a little bit skeptical, but that's the bull case.
So the move from 1 times book, or in the case of Citi, 0.5 times book, or whatever that thing is, to 3.3 is a nice run, just like Saylor had. So I guess what you got to think about is the implied, Jen, if you can put up that chart, that Bloomberg chart, when you get a second. The way that this actually works is it's a volatility arbitrage situation where the implied volatility was almost 200 last Thursday when we peaked out. Not that one, the next one, the Bloomberg one. But you can see right there, though, is that 58 is the current implied vol for 90 days, and the realized vol is 102. The converts are like 60 or 70. So what you do is you basically can take a directionless position and arbitrage that premium out. And so what happens on the way up is guys delta hedge, and so they have to buy as the stock goes up, and they sell as the stock goes down. And since last Thursday, the vol premium is down about 30-40%. The stock is down about 26-30%. That is not a coincidence, my friends. People can say whatever they want and narratives about Bitcoin, but The reality is that when did this thing start working? In September, when the MSTZ and the MSTU ETFs came into being. So let's call that dumb money. And so you got 200 vol plus vehicles that shouldn't even be legal, to be honest, because they're options and people don't even know they're trading options. But okay, so that money comes in, you get a couple $1 billion of flows in, drives the stock up. Then he sells convertibles, then he buys Bitcoin, and then you get the flywheel going. Then you get the amplifier, which is Trump winning. Then you get the narrative machine fully going. Then he does another $3 billion. By the way, this is really legendary stuff. He does a $3 billion
So
convertible
Ben, if you
offering.
want to share the chart, you have to do it production style.
Okay, I don't have my Bloomberg on, so it's okay.
Okay.
But basically, okay, so then you get the amplifier. So you have $3 billion convertible at a 0% coupon and a 55% premium. 55% premium, 0% convertible. I'm sorry, but I'm good with that bond. And so basically, it's bond managers taking some convexity into their portfolio. Allianz, the large German insurer, took down 25% of the last issuance. Okay, so what are we doing here? We're adding convexity, as everyone who's ever heard me talk on the show knows, is a great thing for your long-term portfolio. Because if Bitcoin goes to 1 million or whatever, and you're a bond manager, that can add 100 basis points, 300 basis points, and that could be the difference between your 3 and 5 year number being at the top of the stack versus the bottom of the stack. You get more flows. So it's a totally logical thing for them to do, because they're just trying to take a little mini flyer as a percentage of their portfolio that can be a large outperformer for them, because they'll have that equity exposure in the case of things flying. And so basically, we're in a situation now where if you're on X or Twitter or social media, they're like, oh, have fun being poor and blah, blah, blah. But the reality is this is just mechanical. There we go. So look at that green and red line. That's the difference between the vol premium, the implied and the realized vol. We're at the all-time high. We were at the all-time high. Now we're starting to decline. You see the momentum's on the bottom. The momentum's rolling over. As the vol premium goes down, and naturally the price is going down. So how do you go ahead?
I was going to say, so to me, it sounds like what you're saying is bond players want to own Bitcoin because guess what? It's going up. They can juice their portfolio, and essentially he's selling Bitcoin for a dime to them, taking the premium, and that works as long as this keeps going up. And it will be self-funding for a while until it doesn't, and then you get a Jim Cramer curse or something. Now, what's happened in the last week or so that's caused all of a sudden this downturn, or is it normal? Like it used to be $8,000, it wasn't a straight line to $99,000, and this is just a pause, or how do you?
So on MicroStrategy, he's a huge buyer of Bitcoin. So in essence, it's a self-fulfilling mechanism where he's taking money from the bond market and then from dumb money levered ETFs, which by the way, that's levered, right? So they're using leverage so you have levered buying, you have option arbitrage. So you have guys YOLOing calls, that's leverage. And then he takes that money and he buys Bitcoin, which then drives Bitcoin up. And then he gets the narrative flywheel going. And then in essence, you can create a metastable situation where the price can stay where it is. And this is the same mechanism that happens in meme stocks, for example. So you're like, how could GameStop happen? How could AMC happen? How can MicroStrategy happen? It's just mechanics, right? This is just physics of buying and selling and arbitrageurs, delta hedging, and then there's some element of dumb money that starts the flywheel. And these things go pro-cyclical. And if you look at that chart, you see these green periods of premiums. That's when the stock rips. Then you had the March, that stock rip. And then what happens is the premium compresses or even goes negative. And then they have to sell as the premium declines. And then what happens is the price goes down. And you need to have, in any Ponzi scheme, you need to have more inflows than outflows. So it's about the rate of change of flows. And so if you don't have new money coming in, then it just can collapse on itself in essence. And so this is a guy with $11 billion of market value of debt against him and $7 billion of debt face value. And even if you converted the in the monies, you got $3 billion, but he's got no cash flow. He's got $75 million of cash flow that's declining. Okay, so this isn't like if the guys are dumb enough to take on 0% coupon, sure, it can go for a little while. But if he has to do at the money, then you have the Bitcoin per share doesn't really go up that much unless they're willing to do it at these premiums. So I just think, and to go back to Charlie's point, is it's very hard to sustain a 3.3 to 3.8 times price to book, right? So because think about what you're doing. You're buying a pool of assets at 200 and some percent premium to the assets. So that's just a very difficult way to make money over time. And so, yes, you can have a flywheel effect in the sense that it works for a short period of time. And if you use leverage, you can make a lot of money. But this is not a sustainable situation unless you just think the dumb money from the bond managers, which isn't dumb necessarily, because I do get what they're doing. It's taking flyers. I like buying options with the expectation that I'll lose all my money.
Just a riskier way to own Bitcoin. It sounds like for the individual investor, you might get some great return, but the reality is
they just did.
But
right?
now I will tell you, I do want to end it with the one quote that I heard this week, and I'll probably misquote him, but he was very proud, the CEO, to say that he's the first company in history to do 3 converts in 1 year. I personally never heard that as a positive, but that was a quote from...
When you're running a Ponzi scheme, that is a great thing. You're getting new
money. Yeah, let's dial that down.
Yeah.
What do you mean? It's a Ponzi scheme by definition.
Well, that's your personal view. I'm not going to...
Hold on. This thing doesn't go up. This thing doesn't go up unless more money comes in.
You mean to you it's Ponzi. I just want to be clear. I didn't say it. We're going to move on to Ben.
Mr. Taylor, I didn't say Ponzi.
David, let me save you and make one last observation about
Thank you.
And where they're technically positioned. And while I'm talking, I don't know, Bakes, if you can put up a weekly chart of the KRE going back to 2020. But what I wanted to point out, because the best in trade this week has been lower rates are going to be good for regional banks. And so the regional banks were up big time yesterday. But what I do want to point out technically is they're back now. That KR ETF is back to the summer, fall highs of 2021. And it's got an RSI of over 72. So usually when you get back to those types of highs, you have to do some work before you can break through it. The other observation I would make is the month of November here in 2024, the regional KRE is up 18.7%. That is the 4th best month of the KRE index in history. The other months were October of 2011, November of 2016, and then July just this year of 2024. So it's the outperformance of the KRE and the regional banks in anticipation or in reaction to Trump and the Bessent appointment has been pretty phenomenal. And while I think the rotation into value and therefore bank stocks will probably continue over a multi-year period, I think short term, you got to be a little bit cautious here. I don't know, Kevin, if you have any thoughts about that.
No, the lines draw themselves. We're at 4-year highs. And so you have some resistance, and do we eat through that? I don't know. But that isn't the fewer people that have lost money, the fewer people that are above this line here, above this red line. Most people are making money, and so you don't have a lot of selling pressure. But this is a very logical place to stall with that price history being so strong from 3-4 years ago.
All right,
David.
Well, sounds good. We have Canada and Mexico fighting back against tariffs. Sounds like a Jake Paul type fight, not one that they're likely going.
They should hire him to promote it
and get more people to care. But Trudeau probably has other problems ahead of a trade war on his hands. But we have all that and more to talk about tomorrow. But with that, let's end the show. Thank you to Ben, Charlie, and Kevin. And if you like what you're hearing, or even if you don't, if you don't like it and you want to subscribe, we're okay with that too. Go on there, subscribe out of spite if you want. That's fine. You can ping us all day long with what you don't like about us. But with that, we'll end the show. Have a great day, everybody.
See you, folks.
Spite subscriptions.
Yeah.
All right,
Well done.
Charlie, how
Well
do you
done,
spell
David.
the town name you're in?
Are we off? Are we off, Jen?
You know what, Ben? I'm gonna text you.
Wait. Actually, do you have dinner plans tonight?
I do not. No.
Oh, then come